Hello friends, let's understand about the capital budgeting exercise. So what exactly is capital budgeting? Why is it important? And what are the key features and limitations of the capital budgeting exercise? As we know, project financing decisions are typically synonymous with capital budgeting exercise. The capital budgeting exercise is different from the normal budgeting exercise undertaken for day-to-day operations of the company. That budgeting exercise is typically called cash budgeting or revenue budgeting exercise. Capital budgeting means planning for capital expenditure, which results into creation of some kind of assets like acquisition of a land, construction of a building, construction of a plant or machinery, or new undertaking or a project as a whole. For example, setting up a project to manufacture furniture. According to Charles Holmgren, capital budgeting is long-term planning for making and financing proposed capital outlays. So one of the important characteristics, it's a long-term planning exercise. Capital budgeting is a process of making financial decisions for investing into building capital assets. So what is the importance of capital budgeting? Number one, the capital budgeting exercise leads to acquisition of capital assets, and it has a long-term impact on the viability and the profitability of the organization. If the organization undertakes the decision wrongly, for example, if the estimates of profitability don't work out, it can even put the long-term viability of the business at stake. The capital budgeting decisions that are taken, typically acquisition of assets or undertaking a new project, are by and large irreversible. You cannot halfway abandon those decisions easily without significant financial impact. For example, if you decide to set up, let's say, a new car manufacturing plant in a particular location, for some reason later it is found the location is not good. In that case, if you abandon that particular plant, then you will have lost a significant amount of money. The capital budgeting exercise is done typically for projects where they involve substantial outlays of money. So you are generally putting in a lot of money in creating those assets, and that is higher from the normal day-to-day operations of the company. For example, a company's total expenses during the year could be, let's say, 200 crores, and they might be undertaking a project which is, let's say, 300 crores or maybe even 100 crores, which is a significantly high amount of money. And therefore, anything if it goes wrong with the project, that will have a significant impact on the future of the company. The capital budgeting exercise typically for, let's say, constructing roads, airports, for building a new plant entirely, it involves significant amount of implementation risk. Though we say that in the capital budgeting exercise, the expenditure is made now for benefit in future, that now can mean even 1 or 2 or 3 years. For example, a large project can take up to, let's say, 3 or 4 years to execute. So during that time frame, lot of risks are there, right from, let's say, acquisition of the land, acquisition of the machinery, setting up of that machinery, and so on and so forth. So all that has a significant amount of risk. Last but not the least, the capital investment decisions impact long-term viability of the undertaking. If they go wrong, the entire survival of the organization may be at stake. Normal day-to-day decisions, if they go wrong, you have certain degree of flexibility and you may be able to reverse. You may suffer some loss, but still you might be able to recover. A company which undertakes a very big project is definitely putting its entire future at stake. Now, what are the key features of capital budgeting exercise that separate it from the normal cash or revenue or operating budget exercise? In the capital budgeting exercise, there are a lot of quantification issues involved. How do you, for example, exactly assess what is going to be the cost of the entire building of the road? Let's say it's a highway being constructed, right? How do you exactly estimate that? Because you want to tie up the funds, and at least at a ballpark level, want to estimate the funds and tie up the funding accordingly. So how do you quantify it upfront? The project may get exercised over 2 or 3 years. For example, there is an import of plant and machinery required, and the foreign exchange rate itself is changing, right? So how do you exactly quantify? The capital budgeting exercise is undertaken for the benefits that are going to happen in future, and future is inherently uncertain, right? So those uncertainties weigh a lot on the capital budgeting exercise. You estimate, let's say we are going to sell so many items of this product for which the plant is set up. This is going to be the demand. This is the price at which we'll be able to sell. We'll sell so much domestically, so much internationally. Now all that is an assumption you are making, let's say 3 years, 4 years down the line. Obviously, there are a lot of uncertainties involved. By that time, the other manufacturers also might set up competing facilities. The foreign exchange rate might change, on which you hardly have any control. So inherently, there's a lot of uncertainty involved in the capital budgeting decisions. The benefits that are expected to accrue in the capital budgeting are typically over long term and future. So let's say you are setting up a plant, it's going to take 2 years to set up, and then you expect the payback to happen in next 5 years. Now, those 5 years, there could be significant amount of changes, right? Also, you have put money upfront and then money is going to be recovered later, means, a lot of cost is incurred in terms of servicing the funds that have been raised for the project. Therefore, the capital budgeting requires special funding needs. It's not like a working capital requirement management, or maybe where you request your creditors to extend, let's say 1 month additional credit to you to tide over some kind of temporary difficulties. In this case, you need long-term funds. The capital budgeting funding always has to happen through long-term funds, whether it is equity or it is some kind of a debt. For example, term loans from the bank with some moratorium involved, or maybe bonds being issued in the market, right? So you need long-term and special funding needs for any capital budgeting exercise. Project like a bullet train project which India has undertaken, for example, there is a funding available for 50 years, because you cannot charge a very high fees to the passengers. You have to be very realistic about that. So recovering the heavy investment money in that project is going to take a very long period of time. So the projects might have special funding needs that you need to take care of. Now let's understand the limitations of capital budgeting exercise. You are planning for project financing, you are planning for very long-term projects with significant outlay. So there are definitely bound to be some limitations in the exercise. Number one, there could be a poor alignment between strategy of the organization and the capital budgeting exercise that is undertaken. So the assets you are trying to acquire may not be very well tied to the long-term strategy of the organization. That's why these decisions are taken at the senior most or the highest level. So board of directors have to be definitely involved, and the final approval goes to the shareholders, right? So that takes care of any kind of poor alignment between the strategy and the decisions that are undertaken to acquire the assets. But still there is a possibility that there could be a poor alignment. There could be a lack of alignment between top management incentives and the decision criteria defined for undertaking the investment decisions. For example, the CEO is being sort of under radar. He's under radar. He has to face investors every 3 months. The listed company has to declare results every 3 months, and then analyst calls happen. Because you are undertaking a huge project where all the money and resources are getting devoted, maybe your short-term performance might take a little bit of a hit, right? So how do you align your short-term interests, maybe your sales incentives, right, your profitability, cash flows in the short term with the decision criteria that is undertaken for capital budgeting exercise? So capital budgeting, let's say you're planning for the future, you look at the cash flows happening in future and not today, right? So there's maybe a misalignment between these two. Third, there could be deficiencies in the analytical techniques that are used for undertaking the exercise and evaluating whether you should go ahead with this particular, let's say, project. For example, the base case could be poorly defined. You don't have very clear criteria. You might just assume the status quo in many respects, price, market, so on and so forth. You might simplistically characterize the risks, saying, okay, foreign exchange risk is involved, market risk is involved. Of course, those risks are involved, but are you going into the detailed in understanding what is going to be the impact in case some of those risks materialize? There may be inadequate assessment of all available options. So maybe there are multiple options for investing in an asset. So let's say you want to build a customer relationship management system. Now another option available is to sort of buy, right? You could buy a custom off-the-shelf application, or you might go, third thing nowadays available and very popular is there is a cloud-based system. So you just subscribe to it. So various options are available, and if these are not evaluated in a proper manner, then you might end up taking a bad decision. Capital budgeting exercises inherently involve subjectivity. So when you are estimating the market, for example, right? So you are looking at future. You are saying, let's say market will grow 10%, right? Competition is going to be so much, or the productivity assumed is XYZ for the resources, including the manpower, and you are assuming, let's say, a discounting rate of 12%, assuming that your cost of capital is going to be, let's say, 10% plus project specific risk, let's say 2%. Now all these are subjective matters, and if they prove to be totally off the mark, then you will have a lot of risk in the project. There is a scope for reverse financial engineering to fulfill the corporate acceptability criteria. Let's say the corporate says that every investment decision must yield at least, let's say, 12% IRR. Right, so internal rate of return should be at least 12%. Now there may be sort of the incentive for the person who's presenting that proposal to go and manipulate the projections to sort of make sure that the IRR shown is about 12%, right? So that scope is always there, because all said and done, these projections are done on paper, and in the very nature they are uncertain, right? So there is a bias which might creep in, and you might justify projects that are inherently unjustifiable. There could be a weak linkage between capital budgeting and cash budgeting, right? So capital budgeting and cash budgeting, though these are two different exercises, ultimately it is one organization, right? So cash flows, though they are under operating budget and maybe investing financing buckets, ultimately they are impacting the entire cash flow of the organization. So if the linkage between them is not strong, for example, if you didn't generate enough cash flow from operating or normal day-to-day operations, or your cash budget forecasting goes wrong, then you may not have necessary funds available for your capital budgeting, right? So that integration has to be very, very strong. Other limitation is there could be inadequate post-facto audit, subsequent audit to analyze the deficiencies, and if something has gone wrong, to assign the responsibility in case of a investment in a project. So when later the assessment is done, if you don't analyze the deficiencies that happened adequately, because I think overall everything looks hunky-dory, you did achieve the project within timeline and within budget, etc., there might have been scope to achieve it ahead of time and maybe do it in a significantly less cost. But when this kind of success happens, everything is ignored, right? So that might be something which will that bias will get carried into the next project also. There could be a next project that you could have undertaken with less or significantly less cost, but because you didn't go through that exercise earlier, now you'll still go ahead with the higher cost for the next project. Also, if something has gone wrong, then in that case the responsibility may not be properly assigned to a person or maybe to a group, and proper action may not be taken, which means again the same mistake might be repeated. And last limitation of capital budgeting is the availability of skilled resources to undertake the capital budgeting projects, to monitor them, to review them, to audit them, is generally scarce, right? So you won't easily get people who can execute projects. Some of the companies in India, they are well established in various industries because those founders, those promoters are known for superb execution of the projects. I can take names, but there are companies which have grown very, very fast in India over decades, and one of the key advantages that they had is their top management is extremely good at executing projects, right? So they are able to manage this limitation of non-availability of skills extremely well. So I hope understanding this will help you understand what are the limitations and what you need to take care of when we are undertaking the capital budgeting exercise, and also manage the risk better. You will be able to prepare a strong budget or a strong business case for investment, and now you have understood what are the skills required to get into the project financing domain. If you found this video interesting and useful, please do like the video, share with your friends, and also subscribe to my channel. Thank you very much, and cheers.